Today, I want to talk about EBITDA. What is EBITDA? Sounds like a funny word. If you're a business owner or business buyer, it's a very important word to know. I'm going to define it using the IBBA's glossary. The IBBA is the International Business Brokers Association. They do great work for the business brokerage industry. It's where my certifications come from, the CBI, CM&AP. And on their website, which you can find at ibba.org, resources, you look for the glossary. EBITDA, I'll give you adjusted EBITDA. It is the adjusted earnings before taxes, interest, income, expense, non-operating or non-recurring income or expenses, depreciation, other non-cash charges prior to deducting an officer's salary. But after replacing an officer's compensation and benefits with the market rate and the benefits to replace their functions. It's a measure of the company's operating performance without having to factor in financing decisions, accounting decisions, or tax environments. Okay, I defined it. That was a lot. Here's the simplistic version of that. The EBITDA is a convenient way to measure how much money a company throws off. The company itself, not a owner-operated business, but a company that has a manager installed and is compensated at a market rate. A lot of times we see businesses that have owners that pay themselves more or less than the market rate, and they're being the manager. So what the adjusted EBITDA does is it says, okay, Mr. Buyer or Mr. Seller of this business, let's normalize it to know that this is how much the money will throw off after a manager is being paid. Last point about adjusted EBITDA. When you hear cash flow or SDE or discretionary earnings or seller's discretionary earnings, we have lots of nomenclature for that. That is the same as EBITDA, but in that case, we assume that the owner is operating the business. We're taking out, the owner is the manager. We're letting that owner take the benefits of working full time. And that's an important distinction. So I like to say that if it's going off of the EBITDA, it's closer to mailbox money because you got a manager installed. You should, at that point, if you're owning a business that throws off EBITDA, should be managing the manager and not being the manager. And lastly, if it's trading on an EBITDA, it's probably a higher multiple. People pay more for businesses that have installed management. So EBITDA, super important term for transactions. You know, I see businesses all the time. They do really good top line revenue, but there's nothing left at the bottom. There's no EBITDA. A business that has a high revenue and a low EBITDA will trade for less than a business that has lower revenue, but a higher EBITDA. So EBITDA is really, really important. It's bottom line stuff. If you have a question about your EBITDA, your cash flow, reach out to me, Neal Isaacs, the Raleigh business broker. Put your questions in the comments below. If it's not confidential, if it is confidential, direct message me. Either way, like, comment, share. Let's do this, people. Neal Isaacs, thanks for watching.